Morning and welcome to the Providence Investment Webinar with our special guest, Jonathan Payne, author of the Payne Reports and a Providence Investment Committee member. Welcome, Jonathan. We also have Grant Patterson, MD and founder of Providence, and James Smith, head of Melbourne, also joining us today to ensure we have a robust conversation, which I'm sure we will. Welcome, Grant and James. Jonathan, if I could start, if I may, with a comment you made on the 24th of February this year on CNBC, where you made the call that the markets could fall by up to 25%. That proved somewhat prescient, as we know what happened next. So how are you seeing markets today, Jonathan?
Well, thank you, Michael. Thank you, Grant, and thank you, James. It's a real pleasure to be with the whole team today, and a great opportunity to be able to present once again to your clients. And I apologize, I can't be there in person. Yeah, that comment I made on CNBC, Michael, was Monday, the 24th of February. And as you say, I mean, there's so much that has happened since then. How do I feel today? The very short answer to that, Michael, is I feel a lot better today, given the extraordinary actions by governments and central banks all across the globe. So, in essence, governments have attempted to provide some kind of bridge across the extraordinarily deep economic chasm that has developed beneath us all as a consequence of this terrible virus. Similarly, central banks have engaged in unprecedented monetary actions. So in my brief answer to that is I feel better today, and I'm sure we'll have a robust discussion around that.
Jonathan, thanks for that. Just in regards to the correction, I mean, the speed and the nature of the correction has been incredible, how quickly we saw the market decline and how quickly it's bounced back somewhat. But I'm interested in having a look in your thoughts of that, of whether you feel that we've reached the bottom or not, when having a look at other market downturns. Seems to be a common pattern there where the markets tend to retest their old lows, but we've had a very sharp fall very quickly. I'm just wondering what your take is on that.
Well, yes, and as you know, Grant, financial history tells us that during every crash, we generally have a very sharp drop. Then we get a rally, a relief rally, as investors cover shorts or recover from that first kind of shock. And then we, generally speaking, get a retest of that first low. And in this instance, if we use the S&P 500 as a benchmark, that low was on the 23rd of March. And there are many pundits, commentators who believe we will retest that low. The caveat I would have around that discussion is that given we have seen such remarkable intervention by governments and central banks, this crisis is different in so many different ways. Having said that, I do respect financial history, and there is a great part of me that fears that we will see a retest of that low. And one of the reasons for that is that clearly in the weeks and months ahead, we're going to see economic data and earnings releases from companies around the world, the likes of which no one has ever seen before.
Thanks, Jonathan. And I just want to go back to one of the most stunning days I can remember, last Thursday, I think it was, when we woke up to the incredible stimulus from the central bank in the Fed in the US. And I think in your commentary on one of the shows I saw, you unbelievably significant, a watershed moment and an absolute game changer. And the stimulus was just stunning. I'm just wondering your take on that announcement and the implications.
Yes, Grant. I mean, absolutely. This is so critical, and this is part of the program of the new central bank and government mantra around the world, and that is this whole notion of do whatever it takes. as you say, on Thursday, US time, which was Friday morning for us here in Australia, we witnessed a 2.3 trillion, that's with a T obviously, trillion intervention or action by the US Central Bank, the Federal Reserve. And there were many aspects to that set of options which were truly staggering, Grant. As you well know, we've had discussions between then and now about that program. Really what it did for me is it basically served to impress upon me that the US Central Bank is no longer independent from the US Treasury or indeed government. And in fact, we should now view Congress, US Treasury, and the US Central Bank as one entity. And in essence, what happened on that Thursday is that Congress approved the financing, the funding of so-called special purpose vehicles, SPVs, that could then be leveraged by the US Central Bank and allowed and authorized the US Central Bank to buy corporate bonds, but much more importantly, so-called high yield or junk bonds. This is territory or terrain US Central Bank has never, ever ventured into. In fact, it pretty much is unlawful. However, under Section 13(3) of the Federal Reserve Act, under extraordinary and extreme circumstances, and I think that the authors of that section were envisaging a state of war perhaps, the US Central Bank can intervene in other aspects of the market. This tells me that this whole narrative of do whatever it takes is very much now the case, and also suggests to me that the risk-reward trade-off, or in terms of the decision-making process that is now driving the actions of the US Central Bank, US Treasury, and Congress, is that the trade-off is very asymmetric. The risk here is that the United States, and indeed the world, is plunged into a deep depression with unimaginable social consequences in terms of civil unrest and the like. Therefore, faced with that potential prospect, clearly governments and central banks will do everything they can, everything in their power to prevent that terrible scenario unfolding. And I think also now they've come to the view, let's worry about the consequences of such action for another time. Because here and now, right now, the United States and indeed much of the world faces unimaginable economic distress. And with economic distress becomes a lot of social stress. And we know all about many reports from parts of the community about an increase in anxiety and stress and depression and the likes. So right now, I believe the US Central Bank has sent a very powerful signal. They literally will do everything they can to prevent that scenario unfolding.
And Jonathan, just to take that a bit further with regards to that central bank intervention, do you think they'll extend it as far as actually physically purchasing equities?
James, as you know, that's the billion-dollar, million-dollar, and in this instance, multi-trillion-dollar question. That question has been in my mind since that Thursday intervention by the US Central Bank. Just a little bit of context, perhaps, best enables us, or better enables us, to think through that question, because it's incredibly important. Today, the Federal Reserve's, the US Central Bank's balance sheet is approximately $6 trillion, and that equates to 30% or thereabouts, 30% of US GDP. In contrast, the Bank of Japan, who we know has been engaging in quantitative easing and extraordinary unconventional monetary policy for 20 years now, the Bank of Japan's balance sheet is equivalent to 108% of Japanese GDP. Now, the Bank of Japan for several years now has been buying equities. Indeed, the Swiss National Bank has also been buying equities. I think what we saw last Thursday certainly opens the door to the possibility of the US Central Bank intervening directly into the equity market, but in particular into banking stocks. And I think this is really vital. In 2008, the US banking system were at the center of the problem. They were the problem. They caused the problem. If you think about the global financial crisis, its origins were in the United States and the irresponsible lending practices and borrowing practices by homeowners in the United States. And then the wizards on Wall Street mass-produced weapons of financial destruction in the form of subprime mortgages, which were then securitized into collateralized debt obligations. So Wall Street was very much the problem in terms of the GFC. In 2020, the US banks are central to the potential solution. And in 2020, US banks are in much, much better shape than they were in 2008. It is unimaginable, in my mind, for the US Central Bank or Treasury or Congress to allow the US banking system to fail in this current environment, because if the banks are not lending, if the banks are not pursuing their fundamental role of disintermediating credit throughout the system, then the entire system fails. In that fundamental regard, I actually do believe that the Fed would not hesitate to request authority from both Congress and the US Treasury for the creation of a special purpose vehicle funded by taxpayer money via Congress with the intent and express purpose of buying US banks. That to me would be the next cab off the rank if we saw a further material decline in US banking stocks. So the answer, I'm afraid, which was a very long one, James, to a very good question, is will or do I think the US Central Bank could start buying equities? My answer to that is yes, they could, because we have entered the realms of an environment where clearly we have to do whatever it takes to keep our societies, our economies, and communities away from the abyss, from that very dark place of economic dislocation and depression. And I personally would vote for an intervention in the equity market if it indeed prevented us from falling apart.
Jonathan, I'd like to go on to valuations in a minute, but before I do, with the size of the intervention that's coming from central banks, should we start putting inflation into our thinking?
Yes, yes, Grant. I think it is appropriate, and I believe inflation is clearly a plausible and possible second and third derivative and consequence of the extraordinary monetary intervention that we've witnessed, coupled with, of course, the fiscal intervention. So let's just map out briefly that combination of factors. Governments around the world have had to underwrite their respective economies through wage support, income support, and many other extraordinary actions. And clearly that will balloon out their budget deficits, and that will have to be financed over time, and that will lead to an issuance of significant issuance of government securities to fund that spending over time. So there's that aspect to the discussion. Secondly, the monetary interventions we're seeing, which again, we've never seen the likes of before, over time could manifest themselves through higher inflation. And indeed, when you think about when we come out the other side of this shocking, calamitous global economic crisis, when we come out the other side, one would imagine that there is a lot of pent-up demand. People will be relieved to be able to engage socially and economically, as not quite as they were before, but certainly there will be an improvement. Hence, demand will increase, consumption will increase. However, many of the supply chains and the ability and capacity of companies to make and provide goods may well have been constrained. So we could see an environment where we see supply of goods constrained, being met and accompanied by an extraordinary increase in demand. At the same time, we have a lot more money circulating in the system by definition, because the central banks have provided trillions and trillions of extra dollars in circulation. And when you get constrained supply meeting a lift in demand fueled by extraordinary monetary liquidity, that has all the characteristics and hallmarks of a potential flare-up in inflation. So I agree with you, Grant. I think inflation is now a discussion we all need to have and think about, and how we can potentially protect ourselves against that. But as I said at the outset, I think that is very much a kind of second order, third order consequence. And Grant, I will say this, I think given the challenges that we all have around the world in dealing with this virus, I think that policymakers will be thinking to themselves, okay, fine, yes, higher inflation down the road, but that's a price worth paying for basically keeping our economies functioning.
So if we just go on to valuations, Jonathan, it seems to me, you know, recently the markets have had obviously quite a big relief rally, and they seem to be trading on the narrative rather than the fundamentals. And we can see that by the volatility that's been in markets. We have a fundamental belief, as you know, as being a member of our investment committee, that valuations do matter. And what I'm trying to get my head around is you know, where are we in that whole valuation argument? Because there's so many moving parts. And we've seen the market obviously take the first step to readjust the valuations, as we've seen in this chart. And you were forewarning late last year and early this year that valuations on all measures were stretched. And we've seen that initial fall. But if we have a look at where the markets have bounced back to, you know, it seems to me that we're only back to arguably fair value, and that's with only earnings downgrades, this chart of about 15%. Now, I don't know what the earnings downgrades are likely to end up being. I suspect it's going to be more than that, given the total closure of just about the economy. But my concern is that we're only around fair value, and the world has got a lot worse a place than it was during, you know, the last 20 years.
I agree with everything you just said, Grant, and I certainly agree with you also that valuations do matter. Ultimately, that guides us as to asset allocation, portfolio construction, and investment strategy, and it should always do. I think valuations are at the very heart and the very essence of portfolio management and managing client money. I agree with you 100%. When we came into this crisis, valuations were already stretched, a point you've been making for some time. And therefore, when we have an economic crash of the magnitude that we are now witnessing, you see a commensurate collapse in earnings. So right now, the debate taking place in the investment community is, what is the magnitude of the decline in earnings, particularly in the second quarter? And, you know, you and I, Grant, have had discussions in the last few weeks. Is it a minus 30% year on year? Is it minus 40%? Is it minus 50%? At this point in time, we don't know, because the companies themselves that generate those earnings don't know. So when the equity analysts at all the top investment firms in the world call up their favorite CEO, who they know extremely well, and say, you know, give us some guidance, give us some thoughts about, you know, product flow, order flow, et cetera, et cetera. And the CEOs are simply saying they just don't know. They don't have visibility. Therefore, the equity analyst doesn't have visibility. Therefore, we don't. And so in that kind of environment, it's very hard to establish what exactly fair value is until we get better clarity and transparency around the earnings picture. So in this type of environment, it is a great, great challenge. But I think as we speak, you're going to see further downgrades to earnings, and also companies literally withdrawing guidance, saying, we just don't know. And until such time as we do, we're not going to provide you with an earnings per share projection. So really tough at this moment in time. But, you know, Grant and the rest of the team, I mean, obviously you positioned the portfolios very conservatively coming into this, predicated upon your belief that valuations were already stretched. So you're in a better place to navigate the kind of valuation terrain moving forward.
I know that one of your sons works in London and was bashing the table some time ago before the Fed stepped into the corporate bond market. And if we have a look at what's happened to credit spreads since that time, he was very concerned about the plumbing, if you like, in credit markets and where the credit spreads were. Do you have a feel that plumbing in that market has now been totally plugged, or do you still feel that there's still some stress out there?
I think the quick answer to that is I do think there's clearly still some stress out there. However, prior, as we came into the 22nd and 23rd of March, which was the low for the US stock market and global stock markets, we were seeing ever increasing evidence of a rupturing in the so-called plumbing of the architecture, the framework of the capital markets. In particular, the commercial paper market in the United States froze up, mortgage-backed securities market, massive market, commercial mortgage-backed securities, even worse, in fact, and many other strains around the world. There was a massive demand for US dollars, so the US central bank had to set up special swap lines with various central banks around the world to alleviate the stresses there. Things were really falling apart. And yes, I had conversations with my son at the time, and we were both extremely concerned that the capital markets were kind of seizing up, as they were, in fact, if you recall, Grant, in 2008, and that the Fed needed to intervene. But as I was saying at the time, the Fed wasn't actually allowed to buy corporate bonds, and we now see that they have done. And that intervention has alleviated a lot of the stress. And as a consequence, you've seen high yield and investment-grade corporate spreads contract or reduce, come down significantly from the highs they reached around that third week in March. I'm not going to say that all the pain has been taken, because what we do know is that the credit rating agencies are continuing to downgrade various companies. And obviously in an environment where these companies are not generating any sales, if they have an existing significant debt burden, you know, they're in a lot of trouble. So there'll be quite a few companies that don't make it to the other side of this crisis. And therefore, the credit rating agencies have got the knife out and they're downgrading many of those companies. But what is also noteworthy, Grant, is that the Federal Reserve, the US Central Bank, when they intervened last Thursday, they said they could still buy bonds that had moved into junk territory, i.e. less than a BB+ credit rating, so long as they were investment grade before the 23rd of March. So they're saying if any company that is downgraded after the 23rd of March, they are permitted to actually purchase in the secondary market. So they're doing everything they can, clearly, to soften the blow that American companies are currently experiencing.
Jonathan, if I can just touch on that intervention and bring it back to Australia. And during March, there was some immense volatility in the Australian government bond market. And we've seen our own central bank here intervene and purchasing government bonds. I'm just interested in your observations about the RBA's actions and your thoughts around that.
Yes, I was saying for some time before that I didn't think Philip Lowe, the Reserve Bank governor, would go down the quantitative easing path and was more intent to exhaust conventional monetary policy. Well, clearly the RBA fired all its conventional ammunition and, of course, desperate times require desperate measures, and hence the RBA joined the QE club. I do believe Philip Lowe was somewhat reluctant to join that club, but necessary because, James, as you say, I was speaking to a couple of people at the kind of sharp end of the trading desks in the Australian corporate credit and government bond markets, and there was complete dislocation. And bid-offer spreads had, you could have driven a London bus through the bid-offer spreads in government bond prices here in Australia and indeed across the world. So something had to happen. And the Reserve Bank, and rightly so, stepped in to restore semblance of, liquidity and normal market-making conditions to the capital markets here. So, we're on that train now. And again, it's part of that. We'll do whatever it takes. I also believe that, the Australian government and the Reserve Bank are acting as one, and I think they should. I'm not one of these individuals that has this kind of ideological fixation with balanced budgets regardless of the circumstances. I mean, no one has experienced the economic circumstances that we're witnessing around the world today. As students of economic history, we will know that the shocking events of the Great Depression from 1929 to 1932 took 3 years to unfold. This crisis took 3 weeks to unfold. And when an economy falls into an air pocket, literally an air pocket, and moreover, it was mandated, implemented by government, and this is a crisis that was no fault of anyone's. We can blame the wizards on Wall Street for what happened in 2008, but how can we blame anyone for what happened in 2020 when people walking down the street and everyday people suddenly found out that the economy had been shut down and locked down. So these times call for extraordinary measures, and the Reserve Bank needs to fulfill its role to stabilize the system and provide for a sense of confidence and continuity, as indeed is the Australian government. And those of you, you will know that through my weekly pain report, I was stressing, albeit in very melodramatic and sometimes far too radical language, the necessity, the need for governments and central banks to stand up, intervene, and safeguard people's hopes at the end of the day, provide a bridge of hope to the other side. Because, we're all in this together. I know that's a bit of a cliche, but we are all in this together. And again, as all of you historians listening today, never before in human history have we had one enemy. Collectively, every single citizen has one common enemy, and that's this ghastly, terrible coronavirus. And therefore, in that kind of framework and context, I'm an advocate of the Reserve Bank doing what it has done, and I applaud and support the intervention by the government and the other policy-making entities.
Thanks, Jonathan. Just to sort of start to wrap up and conclude, as you're aware, I mean, big focus of Providence has always been on the protection and preservation of capital for our clients. And you've been involved in all of our investment committee meetings when we've been discussing that. In this current environment, when there's so much noise and so much information, and I hope you're turning your television off every now and then to get some sleep, in this world of so much noise and so many unknowns, what is your advice in regards to what we should be focusing on, what we should be watching in order to make sure that protection and preservation of capital continues, and what sort of strategies generally do you think that we should be watching closely?
Yes, I mean, these are unbelievably challenging times. I think we've all established that, and I don't think any of us on this in this discussion, or anyone in any part of the community would ever disagree with the observation that we live in extraordinary times. To say that we live in an age of uncertainty is probably the greatest understatement anyone could ever make. So what does one do in that type of environment, particularly if one has the extraordinary fiduciary responsibility of looking after people's lifetime savings? First and foremost, and you've said it already, Grant, is the protection and preservation of capital. That always has to be your number one objective. I think if you start there, everything then flows from there. To achieve the protection and preservation of capital, you clearly need a broad range of diversification across various asset classes. You're looking for assets that traditionally and historically have provided some kind of protection and safe haven at times of extreme turmoil, economic, political, and geopolitical. In that fundamental regard, clearly, Grant, you and your team some months ago positioned the portfolio in some exposure to gold, some exposure, for example, to Australian government bonds, and then right across the asset classes, a very broad diversification. In fact, I can't remember, Grant, when you first invited me onto the committee. I know it was a very, very long time ago, and I can't remember for the life of me when it was exactly. But since I've had the pleasure of working with you all, I can never recall your portfolio and the clients' portfolios being as diversified as they are today, which I think is entirely appropriate, because we have so much uncertainty. Furthermore, we have so little transparency and visibility with respect to earnings and even economic growth projections. Hence, it is an absolute imperative, I believe, to provide for capital protection and preservation, and you achieve that through diversification and an emphasis upon those assets that can shield you from some of the extraordinary volatility. So really, you know how much I enjoy working with all of you, and I know that as we went through 2019, all of you on that committee were raising the alarm about excessive valuations and the need to preserve capital, because there's some turbulent times potentially ahead. Now, none of us foresaw the meteorite that hit Wuhan in December 2019. None of us could have predicted that meteorite would carry this shocking, terrible virus, which then burst out of Wuhan and infected and contaminated the world. However, in the lead up to that, very fortunately, you had set up the portfolios to emphasize capital protection and capital preservation through that very important diversification. So, I mean, I think the portfolios are in a good shape given the extraordinary circumstances and economic environment that we're all living in today, Grant.
Okay, well, thank you, Jonathan. Well, we've certainly got the central banks on side, so that's the good news. I think, some of the systemic risk has definitely been taken out of markets, and that's probably why we've seen the recent rally. We're very lucky and privileged at Providence to have you join us in the investment committee, and I'm looking forward to having you back in the boardroom rather than on the computer. But from all of us at Providence, Jonathan, thanks for sharing your insights. Mike, thanks for organising the meeting, and we look forward to having this available to our clients over the next few days. Thank you, Jonathan.
No, thank you, Grant. Thank you, Michael. Thank you, James. Thank you very, very much. And I hope we're with each other in person soon.
Yeah, well, stay safe. Stay safe.
Thank you.
Jonathan. Stay safe.
Thank you very much. Thank you, everyone.